Testing, 1, 2, 3. We're in good shape there. All right, we're going to start in 5, 4, 3. Hello and welcome to this episode of Mic'd Up. I'm Pete Seyler, and today I'm joined by Wes Crill from Dimensional Fund Advisors. Wes, thanks for joining me.
Yeah, thanks for having me today.
Absolutely. So let's jump right in. And DFA essentially pioneered the idea of the size and value premium. Let's start at the beginning and talk about how some of the research behind why these premiums exist and why over the long term they tend to lead excess returns.
Yeah, no, I appreciate the question. And I would say that we pioneered the implementation of those ideas. I will give the academics their due credit in terms of coming up and sort of formalizing the ideas around size and value. But the sensibleness behind pursuing this style of investing is pretty basic. It really comes down to this idea that not all stocks have the same expected return, right? I mean, the market is going to demand different rates of return to hold different securities for a whole variety of reasons. It could be risk-based, like if you had one company that is very mature, very stable, and another company that's going into bankruptcy, well, investors are probably going to demand a higher rate of return to hold the securities of the latter. And so that's going to give rise to these differences in what we call discount rates or differences in expected returns. And if you just think in a pure valuation framework, that's going to flow through so that companies with similar expected future cash flows, well, the one with the higher discount rate or higher expected return is going to have a lower price. So that lower price is really the underpinning behind what we talk about with size and value, because market capitalization is one way to measure price for a company. So smaller market cap is associated with lower price, which again, based on those principles of valuation theory, should be associated with higher expected returns. And value is the same idea as well. That's another way of expressing price. So if you have price scaled by fundamentals such as book equity, a low price or value stock, you would expect to have higher returns than a high price or growth stock. So very basic. And I think that's very important that this has a very sensible underpinning, because it's hard to stick with an investment style through thick and thin if you don't have this really nice theoretical backstop for why you're pursuing it in the first place.
Sure. Now, there's been some skepticism lately as to whether these premiums kind of still exist. Small caps and value have pretty handily underperformed large growth stocks, really for much of the last decade. Do you mind discussing a little bit, the reasoning for this?
Yeah, anytime you go through a stretch of time where the expected premium doesn't go in your favor for, really any style of investing, it's going to lead investors to question whether it still exists. And, that's the reason why I spend so much time talking about the theoretical underpinning for it, because that premise behind size and value premiums really can't go away. In fact, the only way it can really go away is if you no longer have differences in expected returns across stocks, which is a very strange version of the world, I would think. But I think it's important to really understand the behavior of these premiums through time. That's one way that you can, maintain discipline when it comes to pursuing these premiums. And, a stretch of time, 10 years that we've seen in the U.S. where those premiums have been negative, it's not something that a lot of investors are going to be comfortable with. But when we look back historically, it's not uncommon for any premium to be negative for a long stretch of time. Even the equity premium, for example, the return difference between U.S. stocks and 1-month Treasury bills over rolling 10-year periods, it's been negative about 14% of the time. So we shouldn't be too surprised that the size premium or the value premium can be negative over long stretches as well. Over 10-year periods, the value premium has been negative about 22% of rolling 10-year periods, and the size premium a little bit higher of a proportion. So that's helpful to know when you're going into this for two reasons. One, it helps set expectations, but it also hopefully prevents investors from thinking something has dramatically changed. Now, I will mention that when we look over the past 10 years outside the U.S., both the size and value premiums have been positive in developed ex-US and emerging markets. It's really just in the U.S. And I think when you look at the U.S. over the past 10 years, largely this is a referendum on not how poorly small and value have done. In fact, small value stocks in the U.S. have basically nailed their long-run average since 1927. It's really the S&P 500, which is, as we often say, has outkicked its coverage, where the S&P's returned about 15% per year over that stretch compared to its long-run average of less than 11%. So I mentioned all those data points together as a reason why, if you're looking all of these recent results, I think it's pretty clear which one was the outlier.
Yeah, and actually, this is a great segue because, more recently, we've seen a little bit of life, breathed back into the small value asset class, even with all the volatility we saw in the first quarter. Small value stocks ended the quarter higher by nearly 5% on a year-to-date basis compared to a loss of about 10% for large growth names. Can you give us a little insight into the recent performance trends and whether or not this is something that you think could be sustained as we look ahead?
Yeah, I mean, it's been a great quarter. Certainly nice when you have these turnarounds. And that's not uncommon. When we look back at the delivery of small cap values excess return, it does tend to come in fits and starts and large bunches. By the way, that's a really good reason why you don't want to deviate from your allocation to them, because you might miss out on these runs when they show up. But Q1, if we just measure it using the Russell 2000 value as a proxy for small value compared to the Russell 1000 growth as a proxy for large growth, that return dispersion there is in the 86th percentile that we've seen for a quarter. And, as you mentioned, it was right around 15% return spread for the quarter. This is not a guarantee for the year, but I will say every time historically that we have had a return spread between those two of at least 4%, small value ended the year up positive over large cap growth. So not making predictions about the market, but it is a good sign and really builds in a bit of a margin for the year. But, I say all of that with a grain of salt, because we know that prior returns or prior return spreads between small value and large growth have not been particularly predictive over what comes in the future, like whether the past was good, bad, or indifferent, and really largely has no bearing on what we're going to experience in the future. And that's where I need to have that theoretical backstop, because I expect small value to outperform large growth every day. I know it hasn't done that every single day historically, but I continue to believe it's going to outperform, really regardless of what we've been experiencing.
All right, so let's transition to just a quick discussion around DFA's approach to small cap value investing. What gives you an advantage over a simple index, and what have been the key drivers of both near term and longer term success?
Yeah, that's another important aspect. I mean, I mentioned the returns using those indices, but the Russell 2000 value has done about 5% in the first quarter. Well, our small value strategy has done even better, about 6.8, 6.9% over the same stretch. And that's because we position our portfolios so that when these premiums appear, we can add value over the indices. And that largely comes down to the constraints that indices have. Indices are designed and managed not necessarily to pursue higher expected returns. It's to facilitate tracking as widely as possible. And so they have a lot of things like, for example, irregular rebalancing. The Russell indices traditionally have only rebalanced about once per year. I think they're switching to twice per year starting next year. But what that means is that they can have very meaningful style drift. It's not uncommon to see, say 10, 15% of that index is not in what we would categorize as small value. And so what that means is they are going to miss out on some of the premium when it gets delivered. This one example, it's getting a little bit old now at this point, but when GameStop had its huge run back in 2021, clearly it was no longer a small value stock once it shot up in value and became one of the largest companies in the US. And in our small value strategies, we sold out of it very rapidly. But then you look at the holdings in the Russell 2000 value index. So this is happening in January of 2021. Well, the Russell indices were not going to be reconstituted again until June. So over the next 6 months, you've got this gigantic company in the index. It was over 2 percentage points of weight in the 2000 value. So, that's just one small example of how you can have deviation from the asset class. And then you get to just the value of daily implementation. Because we don't track an index, we have the flexibility to decide every day what we want to buy and sell in accordance with the asset class. That means that we can trade potentially more effectively. Small cap stocks are less liquid. They have a lot of variability in trade volume. And so you want to factor that into what you're buying and selling on a daily basis so you're not pushing prices. And then managing things like momentum characteristics. Stocks oftentimes become small value because they've fallen in value previously. Well, if that's the case, some of them might be experiencing downward momentum, which the academic evidence suggests will continue to result in relative underperformance for those companies. And then the last thing that flexibility gets us is the ability to be choosy with what goes into our small value strategies. And that means avoiding what sometimes people in the industry call value traps. We call it small value companies that have low profitability. So companies that are ranking in the lowest of profitability, we will exclude. And so all of these things come together to really give us the chance to add value over the indices, which is what you're seeing so far this year.
Great. Any final thoughts or words of wisdom for investors who may have abandoned the asset class or are a little bit weary about getting back in, given the return advantage they've seen out of their U.S. large growth allocation?
I would say it's never too late to get back in. That's one of the nice things about the premiums we expect in the future. And, I think these are good examples of why it's important to be disciplined with it. But, we believe it's a good way for investors to add value in their asset class, especially these days where you have the market concentration, large cap US stocks, particularly companies with very high valuations. So I know a lot of investors have some sort of uncertainty around that, and having an excellent small cap value allocation is a good way to go about diversifying that.
That's great. With that, Wes, I want to bring us to a close today. Thanks for joining me.
Yeah, I really appreciate the conversation.
Absolutely. And thank you to our viewers for taking the time to watch this video. If you've enjoyed the content, please hit the like button and subscribe to our channel for notifications and early access to future content. Thanks for watching. And we're good.
Awesome. That was pretty efficient.